Good afternoon or good morning. Welcome. It's my hope today to introduce you to, and for some of you to update you on, a mining company that is unlike any company on this panel. It'll be unlike any company in this forum today, and it'll be unlike any mining company on the Toronto Stock Exchange. So we're Morien Resources Corp. We have a very differentiated strategy. We're Canadian-based. We pay dividends. We have two royalties, one on an aggregate deposit and one on a coal mine that's up into production. We don't have ambitions to be the biggest, best royalty or streaming company in the world. We're very, very tight with our asset base. We're tight with our cost control, and we are ruthless with our balance sheet and try to reduce the number of shares outstanding as an example, and I'll talk about that some more. So what's the key value drivers for this company? First off, we have a dividend. We started paying dividend at the end of last year. We're paying quarterly dividends this year. We're going to tie those dividends to the royalty from the coal mines. So as coal production goes up and coal prices go up or down, we'll have a high payout of the cash flow that we receive from that. So this is going to be a cash pay, cash play on metallurgical seaborne coal. We have royalty revenues as our base, so there's strong returns, no risk, no capital. Our balance sheet actually has nothing in the PP&E fixed asset category. We have a strong cash position. We've got $3.5 million in the bank. These are two world-class royalties, and we'll describe those a little bit later. We do look around for selected things. We don't have an ambition to be a huge company, but we will go and look for other bulk commodity royalties. We do look for other bulk commodity royalties, hoping to find something to complement our asset pool. And we buy back shares. We bought back 12% of the shares since we started the program. A little snapshot of our stock chart in blue. Top shareholders, management, and directors own 12%. I own 6% on a fully diluted basis. We're in Nova Scotia, safe jurisdiction. One of the things I like about Nova Scotia is high unemployment, which means you have a dedicated workforce for our projects. This is a slide we're quite proud of. I've often said that we do a lot of small things. We're a small company, and a lot of our transactions are $100,000 or $1 million or whatever. But if you put 3 zeros behind what we did, we'd probably be on the cover of Fortune magazine. We've done about 17 different transactions with this company since we spun it off 5 years ago. So we're very good at, like I said, managing the balance sheet and actually managing the way the company works. Okay, so our dividend. We started our policy late last year. We're going to pay. We paid half a penny last year. One time at the year end sort of thing, and then we're now paying quarterly dividends of a quarter of a penny, so we'll pay 1 cent dividend this year. And we'll transition this. This is a fixed dividend for this year, but as the mine, which is under production now, it just had its first year anniversary. As the mine goes into full production, we'll lift that dividend as it follows the cash flow. So this is a committed decision by the board of directors. We talked about dividends for the last 2 years or so, what we wanted to do with this. So this isn't something that's sort of, oh, we got some cash, let's have a dividend. We want to make this a cash annuity type of company. For people that think coal is, comes and goes, whatever, there's no replacement for metallurgical coal in the manufacture of steel. So coal may have its hot spots or cold spots in the power generation business, but you need it for steel. Our mine is predominantly going to supply the steel marketplace. Here's a picture of our mine. What you like about this picture is it's surrounded by tidewater. So it has access to the global markets. There's a nice paved road you can sort of see coming in the back part of it. So one side paved road, the other side tidewater. Easy to get to, easy to get out of. There's 1.1 billion tons of coal transported in 2016 in seaborne. You can see the routes all around the world there. So it's very much a seaborne commodity, seaborne mobile product. So the Donkin Mine is our primary asset. It's operated by a guy named Chris Klein. Many of you investing in mining will remember Klein Mining here, which was an utterly failed coal mining venture. I think they spent $300 million and came up with nothing. That's not our guy. Our guy's a billionaire, and he developed coal in the Illinois Basin, put his own money into it, and then he picked up on this project and bought it from Glencore, who had 75%, and us, who had 25%. And now he's up and running. He's put about $150 million of his own dollars into it. We had some milestone payments along the way when they bought it from us, so that's where we got some of our cash. The wash plant went into production last summer. First coal export was October of this year. I'm told now the third ship has left port, taking coal off to Europe. And the production level for this is 2.75 million saleable tons per year. They should get there in 3 to 4 years. 25-year mine life. Here's the mine under construction. So that's the wash plant in the center, and that big black thing on the side of it is a nice pile of coal. Here is a trace of coal prices. The blue is metallurgical coal. The gold underneath it is steam coal or thermal coal. If you wanted to think where we will be, we'll be sort of 2/3 of the way up through the blue. is where our coal will probably price out. We have a royalty that starts at 2% of the first 2 million tons a year and goes to 4% for everything in excess of that. So we put some bars together here to show you what this coal could, what it could do, what our royalty would be. And so the bottom is millions of tons, and the side is the amount of royalty. So at 2.75 million tons and $125 US for coal, we expect our royalty to be somewhere around $10 million. Won't bother going through a table of numbers, but I would draw your attention to the bottom line. There's some coal prices. In this slide deck's available at our station next door. But you could see this company paying 10 cents a share in dividend. This is a 60-cent stock today. We may be a small company, but our asset is large. The royalty graph on the left is our coal royalty, the expected band for that. The one on the right is coal royalties that are large assets owned by other royalty-owning companies. So we are a little company, but we have a world-class big asset. For those who believe that coal is dead, you hear that a lot in the media. I got something to show you. Take a look at this graph here. This is world coal consumption by region. And what you can see is that we've had a slow taper off in the Western world, and China has come on over the last, let's say, 30 years or so, and is now representing half the coal consumption in the world. Coal is not going away. Here's the charts of demand growth. They're pretty typical. This is what you typically see going up a few percent a year. We're more than just coal. We have an aggregates project. It's the Black Point Aggregates Project. It's about 400 million tons of grade A granite sitting right on Tidewater in Nova Scotia. We brought in one of the best operators in the business, Vulcan Materials, America's largest aggregates company. They're the operator of it. They're going through the last little stages of permitting it, and that'll probably start production around 20 or 21. That's a 50-year asset. So we'll be clipping coupons on that for a long, long time, and it's a stable sort of business. So we also have 1,000 acres in Georgia, which were in the company that we used to capitalize this. We did a reverse takeover of this to put this asset into the public market. So we got acres in Georgia, which we'll sell. We already sold some acres down there and made several $100,000. So it's sort of stuff that comes in for free. We'll continue to do the share buyback, and we'll keep looking for other royalties. Here's our pricing relative to others. We think we trade somewhere around 0.5 to 1 times our NAV. Other royalty companies tend to trade at 1 to maybe 2, 3 times their NAV. So we think our stock is quite reasonably priced. So 5 reasons to own us. Dividends is one for sure, and they're going to go up as the coal production and coal prices go up. We are a long life company. We've got 25 years on the coal mine and 50 years on the granite project, so we're not going to disappear in a short period of time. The royalty is scaled, and it's really interesting. We get 2% of the first and then 4% of everything after the 2 million ton mark. If they double production, and this coal mine has the resources and the infrastructure to do that, the royalty goes up by 2.6 times. So I think we're sort of being priced on what the mine's permitted to do today, but if they take that 2.75 million tons and turn that into 6 million tons, then we're going to see our royalty go from 10 to 20 or 25 million dollars a year. So there's a big upside if the operator decides to take it up there. His history has been mining longwall mining, which is how we do it here. So it's in the cards that this could happen. And that concludes my presentation in 7.5 minutes. Catch up a bit. Thank you all for your attention.